9, we are in like stage 5 of the audit cycle or audit process. And we're going to be assessing the risk of material misstatements and then assessing inherent risk. So we identify the risks that could happen due to fraud or just due to just human error. And again, our goal always as we think about auditing is these two phrases in italics that we just want to obtain reasonable assurance. It's never a guarantee that the financial statements are free of material misstatement. So it's not like they're error free. So there's no guarantee and they're not error free. We want reasonable assurance that they're free from material misstatement. So that material is a big part of that statement, again, because it's something that would impact a reasonable user. That's what makes it material. So then we're going to talk a lot about the different risks in this chapter. So audit risk is the uncertainty that the evidence that we gather and the tests that we do of the company's internal controls are not accurately representing the financial statements. So again, because we're going back to say, are those financial statements free from material misstatement? So we're going to look at the evidence that we pull and the tests that we do, and then we're making a judgment based on those. So there's always a risk that maybe we're not testing the right stuff, that our sample isn't indicative of what the whole population is. So that's the audit risk. So we have a misstatement at the overall financial statement level. So some things that kind of help us get comfortable with that is if the management of the firm that we're auditing, if they have integrity and they're honest and they have code of ethics and they're following all the rules, that would make us feel comfortable. If it was the other way around, if we thought, ooh, I don't know, they're cutting corners and maybe they've got some lawsuits going on and maybe they've got some fines from the government, and we're thinking they lack integrity, then obviously that's going to increase our risk. Their accounting systems, if it would be an inadequate, if we did our tests and thought, oh, these aren't the greatest processes or internal controls or how their IT functions are running, if those were not up to what they should be, then obviously that's also going to increase our risk. Then there's the misstatement at the assertion level. So that assertion level is when we kind of get down to like the balance sheet level and we look at specific categories within the balance sheet. So we're looking at those classes of transactions, like what happens in the sales process, what happens in accounts receivable management, what about cash, inventory, looking at those things. So there can be inherent risk based on, like, let's say it's a cash transactions. Obviously, there's inherent risk for stealing those. Then there can be control risks as well, and we'll talk a little bit more about that. So here's the risk assessment procedures. So the table kind of gives us a nice little, kind of flow chart of how that goes. So the auditors are definitely going to inquire of management of the company. They're going to perform analytical procedures where they're testing the financial data to see if anything jumps out at them. Then when they actually get into their audit process, there will be observation and inspection of documents. So they may observe inventory being counted. They may go through and inspect, purchase orders to invoices, to how those get into the general ledger. They definitely are obviously there's always going to be discussion among the audit team members, and it'll go all the way up to that partner level. So then again, those kind of things, all of those different procedures are going to provide input for understanding the company that they're auditing and understanding their internal controls. Then it's going to help the auditor identify the risk of material misstatement, and then they're going to use that to develop their audit strategy and their audit plan in response to those assessed risks. So again, like I kind of said on that prior slide, if things are questionable, risk is going to go up and they're going to have to do more testing and more things to get comfortable. If everything looks good and all of these analytical procedures and these inquiries and all this stuff goes smoothly and we feel like it's a company with integrity and they've got great internal controls, then we can perform less tests because the risk goes down. So these are some things that identify significant risk inherent within the client. So the nature of the business, and again, that could be, is it like a very like changing environment, so that there's like a high technological type software company that things are changing all the time. Are they maybe in environmental stuff and they could have risks that they are not that there's going to be fines and fees and that they're not handling things properly. So again, every business could have different risks. Some are going to be safer than others. They're going to look at the results of the previous audit. Auditors always go back to prior year work papers and kind of see what happened last year, see what they can learn from that. So if they have to make any changes this year. If it's a first time being audited and they do not have those prior year work papers, then they're going to want to contact the previous auditors, and get comfortable with the audit. If they cannot do that, that obviously would increase their risk. Related party transactions increases the risk. Non-routine transactions are definitely going to be something they're going to want to question and look into more detail. If there's a lot of judgment calls or estimates being made by the client's managers, that's going to increase the risk. And then looking at their data in their financials, like if they have a lot of overdue accounts, whether it's on their side, like they haven't paid, or even on the other side, like their customers have not paid them. If there's a lot of excessive officer loans that the officers are loaning the company money and the company owes them, those would all be things that would increase the risk of auditing that client and would have to be investigated in detail. Excuse me. This is a nice little figure of this audit risk model. So again, it kind of goes, like a flow chart to say we got to understand the client's business and industry. We assess their business risk, and then we assess our risk of material misstatement, inherent risk, and control risk. And the things that go again into understanding the client's business is the industry that they're operating in, their internal operations, how do they run things, their management, like what's the board like, what's the executive level management like, what are their objectives and their strategies, and then measurement and performance of all those financial data and numbers and estimates and recording everything. So then this formula is a mathematical computation. So we have that the PDR, which is our planned detection risk, is equal to our acceptable audit risk divided by the inherent risk times the control risk. So then they can actually do a mathematical computation to come up with that. But the textbook does say that a lot of times it is just more like not quantitative, but just qualitative. They just judge the circumstances and come up with a risk level accordingly. So again, this gets into a little bit more detail of those items that are in that formula though. So our planned detection risk is that evidence will fail to detect a material misstatement. So there's an inverse relationship on the testing size. So as risk increased, testing is going to decrease if it's a planned detection risk. The inherent risk is determined from prior experience, and they're going to utilize more experienced personnel to review. And then that would be if the risk goes down, testing goes down. So those have an offset relationship. Then control risk is the assessment of whether or not the internal control procedures are effective. So that also is a direct effect on testing. So if risk goes down, testing goes down. So we have lower risk if they have effective controls that we feel like we can trust. And the overall audit risk is that the statements may have material misstatement even after the audit. So our audit will not uncover that. So errors have occurred, the audit has not caught it. And then that's an inverse relationship with testing. So the greater the risk, the lower the testing. So if they had a 0% audit risk, that would mean they want complete certainty, which again is not reasonable. That's never going to be the case. So they're always going to have to assume some risk. If they want 100% certainty, they'd have to test everything in the financial statements. So that's not reasonable or cost effective. Okay, then engagement risk is that client business risk. So that would be the likelihood that the auditor may end up suffering damages. So say if they don't uncover material, if they don't uncover any, material misstatements and they give them a clean unmodified report, could they then later be sued by clients or banks who use those financial statements and then end up suffering? So that's the engagement risk. So the three factors that affect that are the external user's reliance on the financial statements, because those are the people who are going to sue you. So if there's a high reliance on those financial statements, lower risk is going to be accepted. The client's potential for financial problems, again, looking at the industry that they're operating in, maybe how their board of directors runs. If we feel like there's a higher likelihood that they may have financial problems, again, lower risk is going to be accepted. Like that last slide said, we can't go 0%, which means we tolerate no risk. But the lower the risk, then the more we'll have to test. Evaluation of the management's integrity. So again, looking at their operations, is there a high turnover of personnel? Is there a ton of lawsuits going on? When we looked at the prior audit papers, do we see anything questionable? Do we think that they maybe aren't operating with integrity and honesty? So again, any of those things, lower risk is going to be accepted. We're not willing to put ourselves out there as much. So when the audit risk is high, that means we are trusting it and we're willing to take a little more risk, then we don't have to test as much. When the inherent risk is high, meaning that we think that there's problems with their internal control structures or with their management, then testing is going to be high. We're going to want to get more comfortable with the financial information. The same thing with control risk deals with their internal control procedures. So when that's high, testing is high. And then when planned detection risk is high, then our testing is low. Again, it means we're willing to tolerate more of a possible error, so we don't have to test as much. So then risk, again, we talked about this, I think, in the last chapter. They always determine their risk at the planning stage. Again, looking at prior year work papers and things like that, they come up with a level. But as they are in that audit, they can identify things that make them change that level of risk. So we've got an inverse relationship. The higher the risk is what's acceptable to the auditors, which results in less testing to meet their satisfaction. If they have a lower risk level that they're willing to accept, then that's going to increase our testing, and they do need to do more to get comfortable. So you got to kind of understand those relationships, and that can be a little bit confusing. Okay, so that is chapter 9.